In our previous webinars, we spoke about financial and real estate investment. Today, we're going to talk about taxes under the new President-elect Joe Biden. Don't worry, we're not going to talk about politics. We're going to talk about policies, which is a different thing. And very important to bear in mind, we're here doing educated guesses, as Jacob likes to say, guesstimates. I like to say that my crystal ball is as good as yours. So that is why we have today a team of experts. And although they have the same crystal ball, our goal is in the next 45 minutes to have a base scenario for the upcoming changes and possible actionable steps. On behalf of our team, Activest Wealth Management, and my partner, Jacobo Taurel, who is here today, we would like to welcome you to another Activist webinar. We are honored with the presence of our CPA firm, Cherry Bekaert. They take care of all of the tax issues, and I would like to publicly acknowledge and thank you guys for your professional services all these years. From Cherry Bekaert, we have Mike Vidal, partner, and Moises Szyller, tax manager, and the person that I speak mostly every day, some days even more than my wife. Thank you, Moi, for everything. We have
Thank you guys for having us.
Anytime.
Yes, thank you.
We have divided the webinar into two subjects. The first one is personal taxes, where we're going to spend most of the time, and the second part regarding corporate taxes. There are a bunch of proposed changes that would take us several hours and days to talk about. For the time efficiency, we have selected the most important ones for this audience. So without further introduction, I'm going to pass the mic to Jacob.
All right, thank you, Isaac, for the great introduction. Now, this is for our friends in compliance. This presentation is not investment advice or tax advice. You should consult your own investment advisor or CPA to review your situation. Now that we are clear with compliance, we will talk a little bit about politics. No, I know, but this is just to know where we stand. No, so we have right now a Democrat president, a Democrat House, and probably a Republican Senate. No, we're just waiting for January 5. There is a runoff election, as you can see. Right now, Democratic Party has 46 seats. There are 2 independent seats that usually lean Democrat, and Republicans have 50 seats. And here's the game. If Republicans win only 1 seat, they get the majority. On the other hand, Democrats need to get 2 seats, so that way any party doesn't have a majority. You need 51 to get the majority. So that way we would have Vice President Harris to be the tiebreaker. No? So now we take out the crystal ball and we say, what do we expect? No? And we were discussing before the call, and the most probable outcome would be that at least 1 Republican gets the seat. No? Although we know there's no 100% certainty on this, that's probably the base scenario. No? Now that we clear out the Senate, we just going to touch briefly on the House. On the House, you see that Democrats have 222 seats. That's clear majority against 211. But the thing here is that in 2022, we're going to have midterm elections. And part of the Senate and the entire House is going to be, again, up for grabs. No? We're going to see how this changes. But just so you know, this is probably going to last for 2 years, no? The way that the House is right now. I guess that we clear politics out of the way, and now we can start with the policy part.
No more politics, please. So let's start with the personal income tax. On your screens, you can see the current tax brackets for 2020. Biden has given some indication that for people with income over $400,000, taxes will be raised to 39.6% instead of the mix between 35 and 37 that you can see on the screens. But there are many other important things to discuss. In the next page, we're going to touch the deduction part. Jacob. Okay, so he's proposing the phase out of several deductions. The first one is the 199A. Today, some businesses owners are eligible for a 20% deduction if you meet some criteria. Guys, can you illustrate this situation with an example and how the phase out will affect a certain person?
Yes, thank you. So for the 199A deduction, again, a lot of people, certainly not tax folks, that doesn't really mean anything. So we're talking about the qualified business income deduction, and this will potentially have a very large impact. So first of all, what are we talking about here? What is the qualified business income deduction? This is dealing with the taxpayers who operate businesses. So S corporations, partnerships, sole proprietorships, the income from these, you can claim up to a 20% deduction for any qualified business income flowing from them. And just, I think it'll make a little bit more sense as to why this was put in place, but this came into place because when the corporate tax rate was dropped significantly to 21%, now you had this incredible disparity between the corporate rate and the, let's say, the highest individual rate of 37%. So this 199A was in order to sort of bridge that gap a bit for the significant amount of businesses that are flow through and whose income essentially gets taxed at the individual level. In the end, it allows for, again, this up to 20% deduction, which would bring the rate a little bit closer to the corporate rate. So instead of being at a 37% rate, you'd end up with something closer to a 29.65% effective rate if you're able to get the full 20% deduction.
Mm-hmm.
So, and I mean, okay, we could do a whole hour easily or more on this one deduction alone. So it's at a high level and there's a lot of intricacies with it. But this phase out would be there's talk of anyone over 400,000 would not be eligible for this deduction. So obviously, if you're a taxpayer that is currently able to get this deduction, that's a big deal.
And I think, Mike, that's exactly right. I think the only thing I'd add to that was, part of what President Trump had done with the Section 199A deduction is it was a way to incentivize both the hiring of W-2 employees and the purchase of tangible depreciable property. The way we calculate, Mike kept referring to an up to 20% deduction because it's really based on a calculation that takes into account how much salaries you're paying to employees and how much depreciable property that you have in the business. I think another aspect to it is right now you separate that 199A deduction into whether it's a qualified business or a specified service trader business. Mm-hmm. The way the law is right now is that as long as it was a qualified business, you didn't matter what income level you were at, you were eligible for the deduction. With a specified service trader business, the deduction began to be phased out around 350,000 and change, all the way up to 450,000 and change. So obviously anyone above that was already not getting this deduction. Where it really is going to be a huge impact is for anyone that has a qualified trader business by President-elect Biden's proposal. He wants to eliminate that deduction for anyone making more than 400,000.
Wow, it's gonna have an impact in hiring new employees, I guess. Let's move to the second deduction, the cap tax benefits of itemized deduction at 28% of value. So again, let's use an example. I'm a person making $1 million a year. What can I do today that I will not be able to do tomorrow after the new changes proposed are passed?
So right now, maybe we can discuss the second and the third one.
Okay.
Using your example, let's say someone that makes $1 million, if you have certain deductions, you're able to itemize. You have a standard deduction, which is approximately $24,000 for married filing joint. And if you have certain expenses that exceed that amount, you're able to itemize. Those are things such as taxes, our charitable contributions, mortgage interest, investment interest, medical expenses. So those add up to a total of more than your standard, then your itemized deduction. But there is discussions for, so for the first one, the caps, tax benefits, itemized deductions at 28% of value. This is essentially, if you are taking itemized deductions, you can get a value, if you want to call it, up to your marginal tax rate that you're paying. So if you're in the highest tax bracket, currently 37%, some of those itemized deductions can offset some of that ordinary income, and you'll be getting that 37% value for these itemized deductions. So there has been proposals or talk of the cap benefit at the 28% value, even though the highest marginal value of someone, in your example, Isaac, of making $1 million, and under the proposed highest tax rate of 39.6, you're going to be getting taxed at potentially 39.6, but only get a benefit of the 28% for your deductions.
Wow.
The third one, so for the phase out itemized deductions for taxpayers with income over 400,000, this was in place the last time back in 2017 with a different cap amount, but this is often referred to as the piece limitation for your deductions. And essentially for every dollar over 400,000, you're gonna, there's proposed a 3% haircut on the amount of your itemized deduction. So what does that mean in your example of your 1 million? So you're $600,000 over the $400,000 threshold. You'll take that 600,000 times the 3%, and you'll reduce your itemized deductions by $18,000. It'll and then again, just depends on how much you're over that cap. So these are just small items, revenue raisers that will increase tax on high income taxpayers.
Yeah, that is something to consider, whether to do some contributions. We're gonna talk at the end for some conclusions and maybe some actionable steps. The fourth point here is a very important one. Up until now, if you make more than $140,000, you would pay a 6.2% Social Security tax, capped at 142, right? But now, what is Biden saying about it? What is the proposed changes? I guess it says something about if you make more than $400,000, you're going to pay even the 6.2% above the 142.
Yes. So as you mentioned, that the 6.2% has, for the employee portion, has always been capped at that a certain threshold. I believe you mentioned it was 140 or 142,000 for 2020. And what has been proposed is that cap will still stay in place, index for inflation that changes annually. But essentially then anybody over 400,000, it will kick back in. So say someone that makes, going back to your, just an example, if you have earned income of $1 million. A W-2 wage earners, or it could be self-employment income, $1 million. Your first $140,000 will be subject to the 6.2%. Then from the 140,000 to 400,000 will not be taxed. And then now it kicks in again from 400,000 to $1 million will once again get subjected to that, the 6.2%. So this is a significant one that can certainly be a big revenue raiser and a big tax burden on folks who fall into this category.
And I think particularly for those that are both the employer and the employee, if you're self-employed, this could affect you on both ends of the Social Security tax. Yes.
I guess the employee doesn't have a way around it, but maybe the self-employed will need to reassess the situation with his salary, and the profits. So let's switch gears and let's talk about capital gains, Jacob. I know it's your favorite subject.
All right. So usually we talk about capital gains, and we explain to clients, if you sell before a year, you will get taxed as regular income. If you sell after a year, you will get taxed as long-term capital gain, which is as a dividend rate, which is lower. You can see on your screen, there's a table of how it looks today in 2020. And there's the proposal, which Mike or Moises, you want to talk more of what President-elect Biden is proposing?
Yes. So the proposal right now, and on the screen you see the 3 current capital gains rates, and what is being proposed that there's going to be a 4th bracket for long-term capital gains and qualified dividends that will be taxed at the ordinary rate, essentially the 39.6%. This is over $1 million will be taxed at ordinary rates, essentially at the 39.6.
Over $1 million in gains or over $1 million in income?
$1 million in income.
In income.
Capital gains would be subjected to that tax bracket.
Yeah, so this brings up an interesting issue here. Usually by the end of the year, we do the tax harvest process. We sell any losses in the account. We realize them this year, so we can take the hit this year, claim any losses, and if we have more losses than gains, we can accumulate this into the future. But now, given this proposal, for certain clients, basically the ones that are making over $1 million in income, we're having these discussions if we should take part of the gains this year. For example, we talk about positions that are tactical, no? If you have a position that you made that is small, maybe you want to take it out of your portfolio. It might be a good idea depending on what's your situation. But there are some other positions such as indices, no? S&P 500, these are core positions, and usually these are the ones that you don't sell, no? Anything that you guys are looking at, Moises or Mike, in regards to the tax harvesting strategy?
General, this is that going back to the crystal ball comment at the beginning. It's very difficult to make a definitive recommendation. I mean, we're trying to sort of lay out the facts and what, if you felt, and we're going to hit upon this at the end, we have a slide on this, but if you feel that, for example, the Georgia runoff election will, the Democrats will win both seats, and now, you'll have a Democrat-run House, Senate, and President-elect Biden, then, in that scenario, he's going to be able to pass legislation much easier than, obviously, if the Republicans win one of those seats in Georgia. Now, anything that's going to get passed is going to have to be done on a bipartisan basis, which, it will be much more difficult. There very well could be legislation passed, but you're going to have to get at least one Republican on board with whatever you're going to be passing. So it's difficult to answer, but certainly, you can look at that. When it comes to harvesting, like you're talking about, Jacob, if you thought that, let's say in 2021, the rates were going to be higher, then, maybe you wouldn't offset with losses and try and take more gains in 2020 when the tax rates are, what we know they are. The other thing I'd like to mention, though, is even in Trump's first year, where he had a Republican House, Senate, and obviously, the president, they did not pass the TCJA until December. And most of those, with the exception of a couple items, were not retroactive. So most things were effective the following year, starting in 2018. So with that said, the chances that any major legislation would be effective starting January 1st of 21, I don't tend to see it, but, again, it's always a possibility. It's not likely, and it's also going to depend on, again, the crystal ball scenario and what's going to occur in the next month or so.
That's great, Mike, because actually we got many questions already through the chat, and most of them are asking if these changes will happen for sure or not. And you just answered, no? So usually we can see to history what happened before. You were just talking about the Trump. It took more than a year to pass these changes. So in this case, the base scenario for this situation is that it probably is going to take some time. and everything's into question in January 5, no? And if in January 5 we get 2 Democrats, then it's probably going to be more probable and faster, no? But if we get at least 1 Republican, then we're going to see the Senate under Republican control, no? And that way, it probably is going to take longer. Maybe proposals are not going to be the same as they were initially thought, no? So I guess just to clear the air for those that were asking, we have another question about state taxes. We're going to talk about them later in the presentation. Isaac, you want to continue with the next one?
Yes, actually it's state taxes. So in the
Good transition.
Good transition. Then this is the last point we're going to touch base with the personal tax. And this is the most important one that we are discussing with our clients at Activest. On your screens, you can see a table of the lifetime exemptions since 2007, where it was at 2 million, then to 5 million in 2011. Then Trump increased it significantly to 11 million and plus until 2026. It's important to point out that date. What is Biden's guidance on it? We heard 5 million, 3.5. What have you heard?
Seems there is some ambiguity because his actual plan kind of stayed silent on the amount. It just said that it would be rolled back to prior, pre-TCJA levels. I think the consensus tends to be about 5 million, but there's some who do think it could be rolling back to the 2009 amounts of the 3.5 million. So really, the bottom line, I think the takeaway is certainly his plan would call for reducing the amount of the lifetime exclusion, which is currently the 11.58 to probably closer to the $5 million number. What I did want to point out before though, because I could tell you back in September, October, pre-election, there was quite a lot more, urgency and chatter as far as, well, if Biden wins the election and should the Senate, the Democrats control the Senate, there was many people thinking, okay, we got to get this done before year end, estate planning, amount's going to go down. And I think the key now, again, with this, as we've already hit upon many times with the Senate, it might not be as urgent because one way or the other, it can take some time to implement. But I still certainly think this is an area of focus. And if nothing else, even if, let's say, the Republicans maintain control of the Senate, we know that after 2025, it's already slated to go back to the $5 million amount anyway. It sunsets at the end of 2025, and in 2026, we're back to the $5 million amount. So in the very near term, one way or the other, this amount is set to go down. So it certainly should be an area where clients are looking, and if they have not put in a plan, have not used up their lifetime exclusion, there's certainly something to look at and plan for.
Yeah,
and
for us, it's a no-brainer.
I think to add to that, I think, if you use Trump's changes as an example, by the time he passed tax reform, it's almost too late to do true estate planning. I think for anyone that's really concerned, because a lot of these times take valuations, they take time to set up trusts. This is something that, we tend to ask our clients not to wait till December to want to do, particularly because it gives very little time to get it done and it becomes significantly more expensive. There's different tactics that we're working with on our clients with, for clients that say, hey, I don't have enough to give 23 million because right now it's 11.58 per person. We've got clients that we're working on using only one of the 2 spouses lifetime exclusion, so that if they do get hit with a lower estate exclusion next year, you've at least taken advantage of one and you don't take the hit on both, spouses lifetime exclusion.
Yeah, I think it's a no-brainer to execute a strategy. Maybe, I don't know if this year, because we have 20 more days with the holidays in the middle and everybody running up, speaking with accountants and lawyers, creating an irrevocable trust, but it's something that we're encouraging all ultra high net worth clients to set up an irrevocable trust or to put more assets toward the irrevocable trust. So we have finished with
one
the
more
first.
thing I wanted to add, Isaac, or
Yes.
as far as we kind of jumped to the second one, as far as the looking at the exclusion amount, which is the big one most people focus on. But I did want to hit upon that first point of the taxing of unrealized capital gains at death. This
Very important.
I feel has flown under the radar a bit because, again, people I think are focused on the big one, the exclusion amount going down. But there has been part of his talks of proposed budget has been the loss of step up in basis. So currently, regardless of whether you have a taxable estate or not, so if you in 2020 die with a $20 million or an estate less than your lifetime exclusion, so $11 million estate, you will not pay any estate tax, and any assets that are passed to your heirs will receive a fair market value step up in basis. So that means those assets are all stepped up to the value as of your date of death. And then going forward, those who inherited those assets, they turn around and sell them immediately. They're essentially not going to record any gain or very minor gain. Yeah. Part of Biden's proposal, it has been to eliminate this step up in basis, which could have huge impacts on from a tax standpoint. And it still has been ambiguous as to how exactly they would do this, whether it would be taxing all unrealized gains as of your death and kind of pay the tax then, or whether it would just be the assets inherited, that those would be taken as a carryover basis. So whatever the decedent's basis was will carry over to whoever inherited the asset, and whenever they sell it, they'll recognize the gain. But this is a very big one that, again, I think hasn't received a ton of attention, but can certainly have a very large impact. So,
and I think particularly with that one, where we're concerned is a lot of times cash may not be what you inherit. So if you are inheriting a property that causes a capital gain because of the step up, then that could have negatively impact the cash flows, force you to sell distressed assets.
Mm-hmm. It is like a sort of a catch-22. You inherit Tesla at 100 and now it's like 600. What are you going to say? What are you going to do? You're getting old. You're going to keep selling Tesla every year just for the sake of my kids not inheriting that tax liability. I don't know. It's good that you point out, Mike. Thank you very much. So as we said at the beginning, there are a lot of other topics regarding personal income tax. We have a slide there. With not for the time's sake, we're going to pass to the second part of the conversation regarding corporate tax. Please, Jake, take it from here.
Yeah, so when we're talking about corporate tax rates, we have a graph here on the screen since 1919. And as you can see, corporate tax rates are at a historic low, currently at 21%. The indication of the proposal was at 28%. This is a very important change, although we know and history suggests that when we see large deficits from government spending, it's usual to get at some point larger taxes. No, but let's touch on the next point. That it's also related, and it's regarding the 15%. On the global book of income over 100 million. Moises or Mike, would you like to elaborate on this?
Yeah, so I think some of the big things on the business end, Mike touched on the 199A, but one of the things that it's going to have a huge impact, particularly on investments in the stock market, is this new corporate minimum tax of 15% if you have book income of 100 million. So usually what we see with publicly traded companies is, you see their book income. They usually, display audited financial statements, whether yearly or quarterly on a GAAP basis, that really don't have much of an impact as to how tax returns work and how their tax calculation works. So, what we tend to see is you want high book income, low taxable income. That way you don't pay tax. And you always hear about these large tech companies in a high growth stage that are showing significant tax losses or not paying any tax at all. under President-elect Biden's proposal, by incorporating a 15% minimum tax on global book income, it starts to get a bigger impact as to how these companies are going to show their profits or display their financials. But in terms of cash flows, you may no longer be able to avoid paying tax because you're reinvesting your gain. And I think from that perspective, you're going to see a huge impact as to how particularly the high growth companies are going to be impacted fiscally. I think
like Amazon.
Like Amazon, I mean, all these companies that may have never paid a tax before, but if you do look at their quarterly financials on a GAAP basis, they're very healthy companies. It's just they've been able to reinvest their gains and take tax deductions and never pay a federal tax on it.
Yeah, it's an interesting point, and also we're gonna see what corporations do to go through and maneuver, many of the new tax laws. Also, an important point here is how the U.S. competes to the rest of the world. No, as you can see on the screen right now, the tax rate is at 21%. If we go up to 28, that's gonna be higher against the rest of the developed world. No.
Yeah, I think one of the interesting things about and what I think President Trump's intent was when he lowered the corporate tax to 21% was almost make the U.S. a tax haven. By lowering our corporate tax to 21%, which I think there's another chart that we'll see later on that shows how historically it's been, you put us in a position where foreign money became favorable to bring it into the U.S. because of the tax rate. And I think this chart shows it all. You know, the corporate tax hasn't been this low since the 1930s, early 1940s. So by putting us on a global footprint to have such a low tax rate for corporations, because particularly what we see when we have foreign investors is that they come into the US in the form of corporations. For a lot of estate tax purposes, we'll never have foreigners come in their own name. So the 21%, the big impact was the ability to drive foreign revenue and how that's going to impact it. Obviously, there was a huge benefits to the big corporate U.S. companies that are publicly traded because they benefited from that. And the big thing that President-elect Biden wants to do is increase the corporate rate from 1% to 28%, as mentioned on the next slide, which is an increase of a 33% tax. Mind you, these are a flat tax, so no matter how much the corporation makes, it pays either a 21 or proposed 28%, plus most likely some sort of state income tax. Some of the other things that President-elect Biden has proposed is the increase into the global intangible low tax income rate from 10.5% to 21%. What this GILTI tax is what we call it was essentially a deemed or a forced dividend when you have a foreign controlled corporation, a corporation located outside the US that is more than 50% controlled by US people. In the past, so long as it was a passive income, able to defer it. One of the things President Trump did was he came in and he forced an accumulated distribution or dividend payment on the accumulated earnings of foreign operating controlled corporations. And then moving forward, he did an annual forced dividend, which was the GILTI. One of the
like the Apple in Ireland example, right?
Yes, you'd see a lot of these big tech companies putting their IP in Ireland, be able to shield the income with a lower tax bracket, never repatriate it back into the US, and therefore keep deferring the US income tax almost indefinitely. One of the preferential things that he did was, I'll force you to bring the dividend back, but at least I'll give you a preferential rate. And that was, he was taxing the GILTI tax at a 10.5% rate. President-elect Biden wants to double that and put it back at the corporate rate of 21%. Additionally, there were certain incentives that allowed the multinationals to lower their taxes on income earned overseas, something called the foreign derivative income, intangible income deduction. He wants to eliminate that. establish clawback provisions that are forcing the company that when you're trying to navigate the global landscape by taking advantage of lower rates or lower working labor costs outside the US, essentially punish companies for doing that. The confrontation of the global tax secrecy and avoidance. A lot of times we're seeing clients come through us, or at least moving to the US with these foreign complex structures that go through a Caribbean or some sort of islands off the European coast. He's trying to avoid any of that by forcing penalties or extremely complex tax requirements for anyone that has that. And then the anti-inversion rules basically allowed large multinational corporations to use tax-free reorganizations to re-domicile outside the US. He wants to tighten that and make those types of transactions either taxable if you want to do it or no longer eligible.
Interesting. Definitely a complex issue here. I'm sure we can dive much deeper. And it's different when you were talking about Apple and Amazon. These guys, they have all the lawyers, they have structures basically anywhere in the world. But then when we go into more real life example, at least for us, these clients from Latin America that they move into the US and they still have some corporations that they want to receive some income. And that's part of the job that is getting complicated, for you guys.
And I think that's a good point, because a lot of these provisions, particularly the GILTI tax, was designed to punish these large multinational corporations that shielded income offshore. And unfortunately, the type of clients we're seeing where you're moving to the US with your company still in South America or in Europe, you're essentially a casualty of the tax law. They aren't necessarily designed to punish them, but because of the way the law is written, you're impacted by this legislation that's being passed to target large multinational corporations.
Casualty. All right, I guess we can jump into the next one regarding real estate. I guess most of our attendees are interested in this topic. Mike or Moises, you want to talk about the proposal?
Yeah, I think, and a lot of these proposals are just expanding what's out there. One of the big things that Trump came out with the tax reform was an opportunity zone, the ability to reinvest gains into certain low-income urban areas, and not only defer the tax on those gains, but essentially get the benefit of a secondary gain once that investment sells at tax-free. A lot of these projects are designed to increase or better certain areas. So a lot of what President-elect Biden wants to do is enhance those programs, but also make sure that those programs are designed and being implemented for their purpose. I think one of the big issues with the opportunity zones was it came out in 2017, effective for 2018, with a census being used from 2010. And I think just, we're all based in Miami. You look at Miami and Design District, 2010, it was nothing. 2017, it's this high-end mall, and somehow it was being able to be brought into an opportunity zone. So I think that the caveat that a lot of what President-elect Biden's trying to do is make sure that the intent is being accomplished with its execution.
Yeah, not very low income in Design District, I guess.
Yeah.
Not anymore, at least.
Not anymore.
Can you explain, Moises, for those who aren't familiar about opportunity zones?
Yeah. So what an opportunity zone is, and we tend to see it in real estate, but it's not. It's really any sort of business. The tax reform, the Tax Cuts and Jobs Act of 2017, gave the governors the ability to designate certain areas within their state as opportunity zones. There's about 8,000 different opportunity zones across the US. Within those areas, what the benefit was that if you had a capital gain, so it wasn't, you couldn't reinvest your salary, you couldn't reinvest interest on bonds or dividends from stock, But if you had some sort of capital gain, whether business or not, at the individual level, you'd had 180 days to reinvest in what's called an opportunity fund. The opportunity fund, so long as it met certain asset tests, was eligible, would invest in the opportunity zones, whether it was real estate or some sort of operating business. The first benefit is the gain that you reinvested, there's a deferment on the tax due until 2026. There's also two other benefits that if you hadn't realized the gain in 2019, you could get a haircut of up to 15% on the tax. So long as you realize the gain by 2021, you're eligible for a 10% reduction in the tax that's due at 2026. So you not only are you able to reinvest the money without yet paying the tax, you're deferring the tax anywhere from 5 to 7 years. But then the new asset that you were purchasing, whether that's a business or a real estate asset in an opportunity fund, so long as you held that asset for 10 years, the new gain on that asset was going to be tax-free. So, I mean, it gave very favorable terms. I mean, the caveat to this is, you know, we saw a lot of people rushing to do opportunity zones, but unless the deal was a good deal, it didn't matter whether you were getting a tax-free gain or not. You wanted to make sure you were getting a gain before you were investing in an opportunity fund.
Definitely.
It sounded sexier than it really was. And I think one of the things that also gets people on the opportunity zones is it wasn't just the investment, it was figuring out a way to better the property. You see it mostly with real estate, but with people, you know, it works a lot better in the development area than in buying a property in the design district and just operating.
Thank you very much. Definitely something to consider when investing in these opportunity funds that are knocking on our doors every week. So I guess we have finished with the conversation in general, and now we're gonna move into the, I know this is a complicated webinar with tons of information, but we believe there are some actionable steps that we're gonna list below. And again, having in mind what we said at the beginning about our crystal ball is as good as yours. If you believe that Biden's proposal will go through, here are some things that you can do. Now, accelerate income in 2020. So put us some examples that what we can accelerate this year. Maybe that what we spoke about, capital gains.
Capital gains, any business income, you know, if you are waiting to say, you know, it's intriguing because if you really do believe that Biden's plan is going to hinder your tax in the next year, normally we get to this area and our clients are saying, well, what do I do? And the answer is always decelerate income, accelerate expenses. For those that do feel that the plan is going to really hinder and don't want to take the risk, it's the first time where our recommendation would be the opposite. You want to defer your deductions to next year, thinking that next year it's going to be a benefit at a higher tax rate, and then accelerate the income to 2020 to make sure that you're not taxed on that at a higher bracket. The other benefit is, and we spoke about, is utilizing the 11.58 million. And I know Mike touched on it earlier, but when this first law came out, we were really concerned as to what if you used more than what you had before, so more than the original 5 million, would there be a clawback should the amount go back down? Because at the very minimum, it's going back to 5 million in 2026. The IRS come out and said that there will not be any clawback, meaning that if you utilize the full 11.58 million in 2020, and then 2021 or 2026, it goes back down to 5 million adjusted for inflation, there's zero penalty for you doing so.
Beautiful. The other one is the deferred deductions. As you said, no, accelerate income this year and deferred deductions. So another example will be if you have a charitable contribution that you're planning to do to your local synagogue or church or whatever, don't do it. Maybe don't do it this year and do it next year that you know the taxes are mostly probably going to be higher, right? And I think we came to the end of the conversation. Again, if you have any question, you can direct them to us straight. We're gonna do our 100% effort to answer them timely. If we don't know the answer, of course, we're going to consult with our CPA, as we always recommend our clients. So thank you very, very much to all of you. Thank you to our panel. Thank you, guys. Have a great afternoon.